So chapter 8, part D, briefs, depreciation expense. We're talking about straight line method. Asset, something you own for your business. Economic life, the number of years the asset is going to last. An estimate is made at time of purchase as to how many years the asset will be on economic benefit to the business. How long will my car be of value to my company, right? For example, I had a truck, I thought, this is going to be spend $100,000, so it's going to last for next 10 years, right? So there's the 10 year is the economic life. Salvage life basically means whatever is left over. Is the estimate of the value of the asset at the end of its life. What will the asset company car be worth at the end of economic? Basically after 10 years I say, okay, its value is 10,000 now. So that is salvage value. So annual depreciation expense formula. Cost minus salvage value divided by estimated life. For example, the salvage value is what expert feel the asset will be worth in 10 years. As I told you, if I bought a truck for $100,000, after 10 years, the salvage value is $10,000. And estimated life is how many years the asset will be worth to the company. So basically, next 10 years, right? So how do we do that now? So we do here 200, for example, we say $200,000. And salvage value after 10 years is 50,000. So divide by 10. So is equal to 15,000. 200 minus 50, 150 divided by 10, 15,000. So 15 per year can be used for an annual depreciation of goods. If I give an example of my truck, 100 minus 10 divided by 10 is 9,000.
So that much we can depreciation
every year.
15,000.
Yeah,
but in
the very first year it will be half.
So 7.5% बन गई 200
Yeah. So cost of goods sold, equal to beginning inventory plus purchases minus end inventory. Another way the straight line depreciation method can be used. The following two ways will help with your assignments. Looking for cost or book value. Speedy Driving School Limited owns a car which they bought 10 years ago. At the time of purchase, the life of the car was expected to be 30 years. So age is highlighted 30. After which it would have a salvage value of $50,000. So salvage is 50. Assume the depreciation is calculated on a straight line basis. So basically, 30 minus 10 is 20 years left.
Yeah.
Right? 10 years ago we bought it, right? So 10 years gone. So 30 minus 10, 20 left. Its annual depreciation expense is $45,000. Is it? 45. What is the book value of the car today? You have to find how much he paid. So what do you do? Annual depreciation expense is how much is 5,000, right?
No, it's a 45.
No, 45. Annual depreciation expense is 45,000. What is the book value?
नहीं 5,000 लिखना थी mistake हुई है 5,000 लिखना है.
Yeah, maybe by 5, yeah. 5,000, right? 5,000. Annual spend is 5,000, right? So multiply established remaining life, right?
Estimated
100,000.
Right? So 5 multiplied 20, 100 plus salvage. Salvage was 50.
150.
So it's the 150.
150 is also, right? So you have 150.
So the book value of speed driving is 150.
हाँ सता ही फार्मूला है ना जितना इन्होंने ये ना मल्टीप्लाई करता क्या बस प्लस हो गया.
Yeah. Basically you are given 10 years. So $5,000 is the depreciation, right? So 5 multiplied 20, 100,000. Salvage was 50. So you add the salvage value, right? So 150 he paid before.
No, mark book value आ गई ना front prime okay.
Yeah. So the formula for book value is annual depreciation multiply
Remaining life.
remaining life
Estimate
plus salvage.
Plus salvage value. Yeah.
So just remember the formula. Annual depreciation expense multiply remaining life, right?
20 years.
Right, which is 20 plus salvage value. Rather than some companies, just remember the formula.
150 only.
Yeah. Right, and the and what the formula for the other one was annual
Cost
month salary divided by number of years, right?
Like, yeah.
Yeah. So basically in this whole question, what you learned is sole proprietor, general partnership,
Yeah.
limited partnership, corporation,
Okay.
right? And then you learn the balance sheet. You know, asset minus a liability. You
Yeah.
find the equity, right? Then you did the profit and loss statement, which is also known as a income and expense statement.
Yeah.
And then you did the straight line method. Straight line method is cost minus salary divided by number of years. Then the formula for book value is annual depreciation multiply number of years remaining
Plus salvage.
plus salvage. So that this is the
Book value.
and the capital cost allowance.
So they can
That,
ask one of that.
that's used for
Straight line method.
its income tax purpose.
Income tax.
Depreciation.
Yeah, right?
They can ask any of that.
Yeah. And the first year ruling you use 50%.
50% of depreciation.
Right. So